Most people think real estate investing is about buying property. That's wrong. Real estate investing is about cash flow, leverage, time, and survival. The property? It's just the vehicle. The moment you understand that, you stop chasing shiny deals and start building something that actually works. If you want to invest in real estate instead of gambling in it, stay until the end, because everything people obsess over comes last, not first. Subscribe if you want real analysis, not just motivation. And comment below what you think real estate investing truly is. We'll test it against reality. Real estate has one advantage no other asset class offers at this scale: controlled leverage. Think about it. With stocks, using leverage is often a quick way to blow up your account. But in real estate, you can borrow long-term, fixed-rate money against a hard asset. And while you do that, inflation silently erodes the real value of that debt. That is the entire game. Everything else, appreciation, tax benefits, even the specific location, is secondary compared to one simple question: does the property pay for itself while you wait? If the answer is no, you're not investing, you're speculating. Let's break down the first rule most people never learn. If the property cannot survive without appreciation, it is not an investment. Cash flow is the oxygen of real estate. Without it, you are one job loss, one unexpected rate hike, or one bad tenant away from being forced to sell. This is the real reason people lose money in real estate during downturns. It's not because prices fell, it's because they became forced sellers. Their properties couldn't support themselves. The goal isn't to perfectly time the market. The goal is to build a portfolio that can outlast the market, no matter what it does. Survival is the strategy. Now for the second rule: leverage discipline. Debt itself isn't dangerous. What's dangerous is a mismatch. Using short-term debt to fund a long-term asset is how investors go broke. Think about those adjustable rate mortgages on properties with razor-thin cash flow. They are silent killers. When the rates adjust upwards, your cash flow disappears, and suddenly you're feeding the property out of your own pocket. Real estate works its magic when you lock in long-term fixed-rate debt at a rate below the long-term rate of inflation. That spread, the difference between your interest rate and the inflation rate, is your hidden profit engine. It's working for you 24/7, even when you're sleeping. Here's a secret that the pros live by, but almost nobody tells you. The deal is made at the purchase, not over time. You can't fix a bad purchase with great management, relentless optimism, or a fancy renovation. Overpaying is the cardinal sin in real estate because it instantly compresses your cash flow, jacks up your risk, and completely eliminates your margin of safety. Professionals obsess over the entry price because everything else, your cash flow, your returns, your ability to withstand a downturn, flows directly from it. A good price gives you options. A bad price takes them away. This is exactly why market cycles matter. Real estate moves slower than the stock market, but it absolutely follows cycles: expansion, peak, contraction, and recovery. Smart investors don't chase the herd. They buy when financing is a little uncomfortable, when the headlines are screaming doom and gloom, and when sellers are motivated and flexible. They sell when everyone else is euphoric, convinced that this time is different. It's never different. The cycle always wins. Your job is to position yourself on the right side of it, and that often means being a contrarian. And here's another truth that trips people up. Real estate is local, but capital is global. Local property prices aren't just driven by local wages or population growth. They are massively influenced by global capital flows, interest rates, and overall investor psychology. When the central bank lowers interest rates, credit becomes cheap and easy. What happens? Asset prices, including real estate, tend to rise even if the local job market is stagnant. Conversely, when rates rise, borrowing becomes expensive and prices can fall or stagnate even if local demand seems strong. Understanding this bigger picture helps you avoid making purely emotional decisions based on what you see happening on your street. You have to think like a global capital allocator, even if you're just buying a duplex down the road. Finally, let me be crystal clear about something. Real estate will not make you rich quickly, but it can make you rich inevitably if you survive long enough to let it work. The journey has distinct phases. The first phase feels painfully slow. You're saving up, learning the ropes, maybe buying your first property. It feels like you're getting nowhere. The second phase feels boring. Your properties are cash flowing, you're paying down debt, but there's no dramatic excitement. It's just steady, predictable progress. Then comes the third phase. Suddenly, it feels obvious. Your net worth is compounding, your cash flow is significant, and you feel wealthy. But this phase only feels obvious in hindsight. Most people quit during the slow phase or blow up during the boring phase, long before the real magic of compounding ever kicks in. They get impatient, take on too much risk, and get wiped out. So if you're still here, it means you're ready for the part that actually matters. You understand the principles. Now it's about application. How to structure your deals, how to analyze a market, how to finance a property so that it works in the real world, not just on a spreadsheet. It's about building a system that produces results, cycle after cycle. We've talked about the why. In our next videos, we're going to dive deep into the how. We'll cover everything, from finding undervalued deals to structuring creative financing and building a team that protects your assets. This is where the real work begins, and it's where fortunes are truly built. Real estate wealth is built through stacking advantages, not chasing returns. Cash flow pays you today. Inflation pays you tomorrow. Debt paydown pays you silently. Appreciation is the bonus, not the plan. When all four work together, time does the heavy lifting. The most powerful force in real estate is not appreciation. It's amortization with someone else's money. Every rent payment reduces your loan balance. Over 20, 30 years, tenants buy you the asset. This is why patience beats intelligence in real estate. The system rewards duration, but this only works if expenses are controlled. New investors consistently underestimate costs. Maintenance, vacancies, insurance, taxes, management, repairs. These are not exceptions. They are constants. Ignoring them creates fake returns that collapse under stress. Conservative underwriting is not pessimism, it is survival. Another uncomfortable truth: most real estate education exists to sell real estate, not to protect investors. The market rewards boring assets, simple properties, average neighborhoods, stable tenants. Glamour assets underperform because they attract competition and emotional buyers. Professionals avoid anything that requires perfect conditions to work. Now let's talk about diversification properly. 1 property is risk, 2 is exposure, 10 is a portfolio. Scale reduces risk because vacancies smooth out, expenses normalize, and income stabilizes. This is why serious investors think in systems, not single deals. Liquidity is the trade-off. Real estate is illiquid by design. That's a feature, not a bug. Illiquidity protects you from panic selling, but it also means you must plan exits in advance, refinance, sell, or hold indefinitely. If your strategy requires perfect timing, it will fail. Taxes matter more than returns over time. Depreciation, 1031 exchanges, and long-term capital gains treatment are not loopholes. They are incentives. Real estate is one of the few asset classes where the government actively rewards ownership. Ignoring this is financial malpractice. But here's the line most people cross without realizing it: over-leverage during good times. When prices rise, investors get aggressive. They refinance, extract equity, and redeploy into riskier assets. This works until it doesn't. The same leverage that accelerates wealth destroys it when cycles reverse. The best real estate investors are not optimistic. They are prepared. They assume vacancies will rise. They assume rents can fall. They assume credit can tighten. And because they plan for it, they survive it. The final lesson is the hardest to accept. Real estate rewards discipline more than brilliance. You don't need perfect timing. You don't need insider access. You don't need luck. You need reasonable entry price, fixed rate long-term debt, positive cash flow, conservative assumptions, time, that's it. Everything else is noise. Most people fail in real estate not because it doesn't work, but because they try to make it do what it was never designed to do: deliver fast profits without risk. Real estate is slow, heavy, and unforgiving, but relentless if respected. If you understand this, you're ahead of most investors already. If you don't, the market will teach you, eventually. Subscribe if you want reality over hype.